Welcome everyone and happy Thursday. Thank you all so much for taking the time to join today's webinar. But today we're going to be talking about creating generational wealth through real estate inside of your IRA. It is top of the hour and I do want to be respectful of your time. So we'll go ahead and get started. Again, I'm Reneika Lightbourne with Advanta IRA and I'm delighted to be joined by Rose Jarboe and also Mark Burns of WePartner Group. Welcome Rose, welcome Mark. Thank you so much for being our featured speaker today. Okay, so WePartners, they'll cover some of their proven strategies and techniques, and they'll also kind of give us some insight in terms of how they target specific areas with strong growth opportunities and their way of creating generational wealth through real estate. If you have any questions, definitely feel free to put those in the question box. We'll answer as we go, but we'll also make sure I allocate some time at the end as well. Before I turn it over to Mark and Rose, I do want to kind of give you just a general synopsis of what self-direction is, how it works, and then of course, the process to get started with us when you're ready to set up your account. Again, I'm Reneika Lightbourne with Advanta IRA. I'm one of the business development specialists here. I've been with Advanta as an employee for about 5 years now, but I'm also an Advanta IRA client prior to joining staff. So self-direction is something that I do personally. Obviously advocating both personally and professionally as a great tool and resource for most Americans to utilize to grow retirement wealth. If you have questions or there's something on the call that you want to kind of talk through more, or you want to kind of look at your scenario, making sure that, if or when you do decide to self-direct, how you can kind of tailor it to your specific needs, definitely feel free to reach out to me via email, or you can give me a call. Or visit our website at advantaira.com to schedule a consultation. So just a quick disclaimer before we get started. Just know that at Advanta IRA, we don't give our clients any tax, legal, or investment advice, and we don't endorse any particular product or service. All of the information that we're going to present today is, of course, as always, is for educational purposes only. So before making any investment decisions, you're always encouraged to consult with your professional team, whether it's an attorney or CPA or financial advisor. So just quick takeaways if this is a new concept for you, or you just have some familiarity with self-direction. Just know that any IRA or former employer plan qualifies to be self-directed. The beauty with self-direction is you're always in control, meaning you get to decide what is it that you want to invest in. Today, we're going to focus specifically on real estate related assets. And then, of course, all of the benefits, having those interest, those dividends flow back into your retirement account, tax-free or tax-deferred. Just a little history about Advanta and who we are. We've been in business for 21 plus years now as one of the leading self-directed IRA administrators in the country. Our headquarters is located in Tampa, Florida area. Advanta also have an office in Atlanta, which is where I'm based. But we do work with clients nationwide as we have about $3 billion under administration. In addition to providing you great educational content that features experts and practitioners such as Mark and Rose, we do also provide our clients that concierge style service to where if you have an account with us, you have a dedicated account manager, someone who's going to be with you for the life of your account with us to kind of help you complete those investment transactions. We do a lot of educational events. This is recorded. This will be on our YouTube channel, typically within 24 to 48 business hours. But you can always go to our website, check out our events page, Pitch, Promote, Prosper. You can certainly tune into our podcast that's hosted by my colleague, Alex Kearney. So exactly what is a self-directed IRA? Just very simply, self-directed IRA is that you as the account owner, you're going to have complete control over your investment decisions. You get to pretty much control what is it that you invest in. And of course, diversifying outside of the traditional stocks and bonds. Most of our clients, like we're going to be focusing today, have holdings in real estate related assets, whether it's single family or it's a rental or a commercial unit. You can certainly also use IRA funds to invest in syndication of multifamily projects, private equity. You can invest in precious metals, oil and gas. The list goes on in terms of what's on the table for you. You have a long list of things that you can be investing in using retirement funds. So why do people choose to self-direct? You may look to self-direct for many different reasons. I'll just touch on a few of them. One, it's a new source of capital for you. So instead of tapping into your rainy day fund or taking out a bank loan, if you have funds that's sitting in an old employer plan, let's just say you left the job a couple of years ago and you have a 401k that's just sitting idle, you can elect to move those funds over to make that investment. Or if you have a brokerage IRA at the Fidelity's or Charles Schwab world, you can move as much or as little as you need to make your next investment. Another reason as to why someone may look to self-direct is because they want to be able to diversify. For example, real estate, we know it's a tangible asset. It's always going to retain some value. People are always going to need a place to live. There's a lot less volatility compared to the stock markets, the ups and downs. And then, of course, the tax benefits, having those rents, those profits, those dividends flow back into your IRA tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it's the ones that you're already familiar with. Again, the term self-directed just means that you as the account owner get to decide what is it that you want to invest in. But if you go to the IRS website, you'll see where the account types are traditional, meaning pre-tax, you get the tax break up front. You grow your account over time, and then once you reach retirement age, you take out funds. That's when you start to pay your taxes based on whatever tax bracket you're in. Whereas with the Roth, it's, you elect to pay the taxes up front, grow that account over time. As long as you've held that Roth account for 5 years and you're 59 and a half, those distributions will be tax-free at that time. If you are self-employed or you have a side business or a small business or you're an entrepreneur, you can certainly look to self-direct a SEP, simple or solo 401k or individual K. A lot of real estate investors or real estate professionals specifically like the individual plan just because you do have greater flexibility, which includes higher contribution limits and so much more. If you want to know more about that plan to see if it's the right fit for you, again, definitely reach out to myself or one of my colleagues and we can kind of talk through it. Some lesser accounts that are just as important in terms of the ability to self-direct is educational savings accounts. So if you have kids or grandkids or nieces and nephews, you can certainly look to self-direct an ESA for them to cover educational related expenses. Also if you have a high deductible medical insurance plan, you can look to self-direct that HSA. You do want to confer with your plan provider just to ensure it's a high deductible plan, but if it is, you can self-direct. And then, of course, any form of employer plan, again, like it's an old 401k, 403b, 457 TSP, or any type of pension plan, you can elect to self-direct. The only thing that I want to privy you to or be mindful of is if it's a current employer plan and you're not yet 59 and a half, which is the IRS retirement age, there may be some restrictions, meaning don't be alarmed if your employer tell you cannot move it because it's a current 401k, meaning current job, and you're not yet 59 and a half. That's industry standard. You can see if they'll make an exception, but if it's a former employer plan, then you can certainly move those funds over. In addition to funding your account, you can transfer from an existing IRA. You can move as much or as little as you want to or need to. There's no tax liabilities for you to do that. Advanta, as the receiving custodian, would submit that request over to the other custodian to get those funds moved over. You just need to make sure whatever amount that you decide you want to move, you can just make sure it's liquid, it's in a cash position, meaning not tied up in stocks or bonds. If you have an old employer plan, like a 401k, again, you would have to initiate that request. You would have to reach out to that plan provider to tell them you're not taking a personal distribution, you're just moving it from one qualified retirement account over to the next. We'll be able to walk you through and guide you through that step. In addition, you can also fund your account by making annual cash contributions. As long as you have earned income, you're able to contribute. For traditional or in Roth IRAs, if you're under the age of 50, you can put in $7,000. If you're over the age of 50, you have an additional $1,000 to where you can contribute up to $8,000 in that account. For SEPs, employer-sponsored plans, you do have higher contribution limits to where you can put in up to 25% of your earned income, not to exceed $69,000. Solo 401k, again, designed specifically for entrepreneurs, business owners. Essentially, you get to contribute twice. You get to contribute as an employee, but also match up to 25% as an employer. So you have higher contribution of $69,000 if you're under 50. If you're over 50, you have an additional $7,500 that you can put in. For ESAs, it's $2,000 per year per child. For an HSA, depending on whether you have an individual plan, it's $4,150. If it's in a family plan, you can put in $8,300. Another thing to be mindful of is with HSA, if you're over 55, you actually have an additional $1,000 that you can contribute to your HSA plan. if or when you're ready to start it with setting up a self-directed account, certainly you can reach out to us. The process with us is pretty straightforward. You can actually go to our website, fill out the application. It'll prompt you, walk you through the steps, or you can reach out to myself or one of my colleagues, and we can certainly help you with the application, help you get everything completed correctly. Once you fill out the application, you have an account with us, you'll actually be assigned a dedicated account manager. Again, that account manager will work with you, work with your advisors, or any investment provider that you're working with. Step 2 is then funding your account, whether it's a combination of making cash contributions, transferring from an existing IRA, or doing a direct rollover of an employer plan, former employer plan. And then finally, step 3, start investing. Is it something that you'll hear on the call from WePartners that you want to pursue more, interested in? Is it something other real estate related investment like tax liens or short-term rentals, or any other type of private asset that you're able to invest in your self-directed account? And with that, I'll go ahead and make WePartner the presenter. So just bear with me. Let me turn it over to Rose and Mark.
Thank you, Reneika. Thank you for the opportunity, allow us to share our company and our story. And thank you for everyone who participating. Take a precious time out your day. We're going to do the best we can to make this session productive and helpful. So I'm going to spend a couple of minutes to just introduce myself and our company. My name is Rose Jarboe. I am the CEO of WePartner Group. We are today will be Mark, our wonderful advisor in capital sourcing. Both of us will be presenting, share our story, and look forward to spend this time with you all. I want to start with our company, since that's where my full-time job is, right? So WePartner Group is Atlanta based. We're based in Atlanta, Georgia. For some of you who knows Atlanta, we're in Peachtree. Our home office in Peachtree Corners. We are a fully integrated real estate investment and a management company. We started in 2014 and continue to grow throughout the last. This year, we actually enter in year 10. Big deal. So as you all know, in last 10 years, there's lots of going on. We were blessed to have amazing 5 years of growth all the way to 2019. We have managed, acquired, and sold about $300 million assets. And as of today, we're still effectively managing $200 million assets. With that being said, the way that we have grown our company and to build a brand, because we have grown a team. We're integrated means we manage most of our assets in-house, which I will share a little more in the next few minutes. A little bit on myself. My background is accounting and finance, and I worked in nursing home industry for about 15 years. For 9 years, I was a corporate controller. So being a trained accountant, that gave me a conservative approach and always analyze. I believe numbers don't lie unless people intention to lie with the numbers. So that's where we start during our due diligence, and that's where we implement throughout our practice. What makes our company special? What makes our company important? So we believe our values. It's our values that drives our behavior. It's our values that give us the guidance. And our commitment to our investors and our partners and our staff, our team, is everyone holds professionalism and transparency, of course, integrity, and all three of this guide our business and practice. As you know, real estate is not industry to be in. There's a lot of work to do. and they're always constantly changing, and one deal after another. So what really help us to grow, and what really help us to get up in the morning, is to be able to focus on something greater than finish a project, something greater than making money. That's what we focus on, community, and WePartner itself is a community. And some of our projects, such as shopping centers and offices, and we see that as a community. And our job is to manage the assets and also grow that community. And that's what we do, and that's what makes our company a special real estate company. As I said, you know, this PowerPoint helps me, so that actually, as I said, end of the day, we rely on each other to survive and thrive. I hope that helps everyone understand who we are and what we do. And for the next few slides, I'm going to turn that to our advisor, Mark, to take you.
Okay, thank you, Rose. Once again, this is Mark Burns. You guys received my bio, and I don't want to age myself too much, but I have spent more than 40 years in the finance accounting industry, globally in various controller, finance and accounting roles. So anything related to finance, math is right down my alley. But if you'll pay attention back to the slides, I want to talk a little bit about generational wealth and what that really means to you and I. When we think about generational wealth, we think about assets that are going to be passed down from one generation to another. In some cases, those assets are transferred after death, and in other cases, those are passed to the next generation while the giver is still alive. Those strategies can be made up of investing in education for the next generation. It can be financial markets, it can be real estate, and it also involves ensuring that we preserve those assets for those generations. Over the last few months, I have had the opportunity to talk to another number of family offices. And it's amazing to me to talk to these family offices and look back at the history of wealth. And in some cases, the wealth goes back 100 years or more. Of course, it's always important that we maximize tax benefits. So if you think about the investment vehicles that are available to us today, and all of these are available to us, but they're available in various means, and it's we involve ourselves with these based on our level of confidence, be it a money market fund, an index fund, savings accounts. In the case of with Reneika talking about Advanta, IRAs, or it could be 401k plans. Some of those IRA plans can be directed or self-directed, as Advanta offers. You may be involved in various stock investments, bond funds, or other securities. But today we're going to focus on the private equity side, which is what we at WePartner hang our hat on. Before I go into a little more granular, I found this a couple slides, and it was just an interesting view for me. But if you think about what the typical American has invested in non-retirement accounts, if you look in those various age groups, and there's no surprises here, age group in the 20s, they're getting on their feet, they're buying their first home. It's all about beginning their life as such. When you get into the 60s, these folks are hopefully they're accumulating wealth and they're preparing for retirement. If you look at average net worth, a very similar net worth by generation. If I look at, and I'm a baby boomer, I guess I'm happy to say that, but baby boomers are retiring. The silent generation, unfortunately, those folks are working toward end of life. But if you think about those three buckets, Generation X, baby boomer, and silent generation, I read a story just a few weeks ago from Yahoo Finance, and it talked about the trillions of dollars that are going to transfer over the next 20 years to the Generation Z and millennials in America, or actually in the world. So there's a lot of wealth that's about to begin to transfer. So in our case, we believe in building wealth through private equity. A private equity investment is not listed on a stock exchange. It's a private company. In our case, we buy assets. Those assets can be residential or commercial. We hold the asset, we improve it, we do the property management. Eventually, we want to sell the asset at a profit. The investor then is able to take advantage of those long-term capital gains, tax advantages. The distributions can happen a couple different ways, K1s or 1099s. The key thing about private equity, and this is probably most important for me, is that these investments are not generally impacted by the daily market conditions. I am personally an investor in private equity, and the reason why I moved into this type of environment is because now that I'm in that retirement area, those daily fluctuations of the stock values in the stock market, they get old. You know, one day it would go up 3%, next day it would go down 3%. And I was looking for some way to invest where I didn't have those daily changes in the market, and all of us, of course, need to be able to sleep at night. So WePartner, what do we do?
Mark, a question
Yes,
just came in, if you don't mind me interjecting.
Sure.
It says, how will the current market condition impact your investment strategy for commercial properties?
Okay, that's a great question, and none of us have forgotten, or nor will we ever forget, the COVID years. And during those COVID years, the companies sent their employees home. So during those times, office space became very available. In our case today, we've weathered that storm. We've come out of it very strong. I will tell you, though, that it is a challenging market, be it on the commercial side or residential side, because cost of capital is expensive. So we have to be very careful as we look to acquire assets to ensure that the cap rates or the investment rates are able to be at such a level that we're still able to make a profit, but also fund the debt or equity. So back to this slide, this is just kind of a circle of who we are, what we do. We have portfolios that we are involved in. We have asset management. We do property management. Where we can, when we buy a commercial or residential asset, we want to do the property management for two reasons. First of all, there's a revenue stream, and then plus we want to make sure that the property is well cared for, because eventually we plan to sell that asset. Sometimes it may be 3 years, 5 years, 7 years. So what is our strategy? We are niche. We primarily invest in commercial real estate and build to rent products. Build to rent is when we go in, we buy the whole subdivision, and all of those homes will be rental homes. It's a very, very captive market, and there is a great need for that right now. There is more, especially because of cost of debt and cost of mortgages. More and more people are finding that they do want to find a single family home or a townhome, but they can't afford the cost and the down payments that are required. Our niche is $5 to $25 million. We are the type of company that we're going to acquire assets that are, too large for an individual investor, but too small for the big investors out there. Our holding time generally is 3 to 5 years, depending upon the type of asset. Our goal is to take the asset, improve it, and then eventually sell it for a profit, and then give that return to our investors. Our target return is about 15% plus or minus. Obviously, maybe higher, maybe lower, and I'll show you a couple examples here in a few minutes that will give you some explanation on that.
Okay, Mark, a couple questions just came in, if you don't mind.
Okay, go ahead.
So let's see, question is, how many rental properties do you currently manage? And also, what steps do you take to ensure you're getting quality tenants for your properties?
We currently have about, I think I have that listed on here. Actually, it's probably the next slide. We have 170 residential units currently. And I'm sorry, what was the second part of that question?
The second question is, what steps do you take to ensure that you're getting quality tenants?
I tell you what, I'll let Rose answer that question. She's right here.
Of course.
Okay.
Yeah, happy to answer that question. So as far as our asset class, we actually focus on three. One is the residential component is a BTR, and we also have retail and industrial and office as well. So it's a primary CRE asset class. To answer your specific question, how do we make sure we get a quality tenants? That goes through a screening process. And there are 10 boxes we have to check off before we bring in a tenant. Number one, they have to fill out application. Then we check their background. We run that background check. We meet with the tenant. And then we make sure they meet all the pre-screening qualification criteria before we bring them in. That I absolutely encourage all the property owners to spend the time to secure the right tenant, because sometimes if you are in a hurry because everyone has a mortgage to pay, and not too many people can sustain too many months of that cash outflow, nothing come in. But if you get anxious and bring in the not qualified tenants, you could be heading to a lot of problems. So definitely do enough homework, enough, we call it due diligence. Make sure do enough due diligence before you sign that lease. Because once you bring a good tenants, you could sleep really well for years to come. So that's worth the wait. And worth the investment. I hope that answers your question.
Yes, it did. Thank you so much, Rose. Thank you, Mark. Another comment or question wanted to be follow up. It says 15% plus or minus what? I think, Mark, you was talking about the possible rate of return.
Yes, that is. I'm sorry, I probably didn't include that ratio, but it is the internal rate of return of plus or minus 15%, and that is an annualized return. So if we, if it's a 3-year investment, we hope to be able to return to the investor 12% each year.
So just a disclaimer, that's the past performance. We're lucky. We actually started the company during the up market, so we have definitely delivered great returns to our investors.
Okay.
As far as the strategy is concerned, we are more into low risk and very conservative approach moving forward. At the end of the day, making money is wonderful, but be able to sleep at night is a must.
Thank you. Another question came in just related to IRAs. It says, if I invest in WePartner in my Roth IRA, will this generate UBIT, which is unrelated business income tax, and or disqualify your Roth? It won't disqualify your Roth. UBIT is if your retirement account is invested, in a business that's operating. So it just really depends on, how are you as the investor getting returns back to your IRA, if it's, being reported as dividends or something else, or earnings or so forth. It could be subject to UBIT tax. Obviously, you do want to confer with your CPA or a tax professional. Sometimes, obviously, if the numbers make sense, you would still do the investment. So don't let UBIT possibly deter you from an investment as long as you, again, do your due diligence. But UBIT may or may not apply just depending on what is it that you're investing in. Go ahead, Mark.
Yeah, that's a great question and great answer. And we do have a product available that we feel avoids that potential taxation, and Rose will go through that later. That's actually where we will issue a promissory note to you as the self-directed IRA holder and pay interest on that investment which is then not subject to that net income profit, but it is taxed as part of the self-directed IRA, which is deferred. Okay, so
Yes,
let me
if
move
it's
forward.
If it's a traditional Roth, then it'll be, tax-free once you meet the IRS requirement, 5 years and 59.5.
Yeah, and I would always advise each person to seek their own tax guidance. I still do my own tax returns, but I only do my tax returns for my mother and me. So if I can move forward, this is a breakdown of our current portfolio. We are heavy in office, and I will tell you, if you saw that initially, you would probably have a fright, and during COVID it was tough, but I will tell you that we have come out on the office side very good. We are very high frequency now of occupancy, so we're feeling good with where we are with office, but our target is retail and flex. Here are some pictures of some of our commercial. I don't really want to take the time to go through each of those, but you can see the types of buildings we have up in the top left-hand corner there. That is a facility over in College Park. That facility is heavily leased to the federal government. And then we've got some office complexes, and then toward the bottom there, you'll see some of our retail offices or retail establishments as well. Here
Mark,
are
these A, B, and C neighborhoods? The type of neighborhoods that you specifically target, A, B, C, like does it?
We target build to rent neighborhoods, although we do have some single family residential, but our primary residential asset now is we seek build to rent, where a developer builder will build out 5, 10, 20, 50, 90 homes, and then we acquire that asset as a rental property, and we rent those homes to our customers, we'll call them.
And I can add to that question, that answer. For our retail, we also like to acquire neighborhood retail, because that will give us opportunity to add value. Primarily, retail is the same, is more personal, because that's where small business owners, mama pop shop, that's where they make a living. Once they have a place they're comfortable, they can make a living, they normally don't move. And that's where we see that being a local operator and a local real estate investment management company, that's where we take care of our tenants, we take care of property, and they make a living and they pay our rent. So that's where we're also targeting. And another asset class that we really like to acquire is called light industrial flex. As you know, since COVID, a lot of people move into those businesses and move into those buildings and figure out how to do things online, how to sell products. So those products are very hot in the commercial real estate market. So basically, that's where we're trying to focus on the three markets. Three asset class is build to rent in residential, and neighborhood retail, and the flex buildings.
Okay, so I'll move on. Here are a couple examples of some residential properties. These are actually built to rent. That one on the bottom left there is in Calhoun, Georgia. It has nearly 90 homes in that particular development, all rented, very high occupancy, very strong occupancy. So at this time, I'm going to turn it over to Rose, and she's going to go through some of our case studies and just highlight some of the things that some of our actual results.
Okay, so I'm happy to. Just to add it to the last slide, there's a reason for our company called WePartner, because that's our approach. As you all know, in real estate, it's very it can be, especially in commercial real estate, it can be very complicated. That's why we take the approach to work with the best, to work with the expertise in the space that they are very good at. One of the approaches we're taking is to JV with the developers, with the builders. Imagine for a builder and developer, what's their biggest worry? Their biggest worry is if they build something, they can't get it sold. So what we do is we JV with them and we help them. We also invest with them because some of them, as far as the development is concerned, is a little, they can use equity partner. So we invest with them. And we also help to manage, help with the products. At the end of the day, that we have a good chance to acquire those products and manage it and own it like a BTR community. In some cases, when end up selling them retail because the market is just so good. But when the market is not great for retail, maybe like right now, we actually can turn that into a BTR community. What that means is that we have two exit plan. One is sell retail, and the second is sell managing as a rental community and sell at a cap rate later on. Okay, so that's our residential. That's our strategy with our residential properties. Okay, I want to add quickly, the reason that this type of investment allow us to execute because we have a great team that we could help them design the product that's sellable or rentable, and we also take it in-house to manage and lease. Another case study, we're still currently holding this property. This was acquired right before COVID. And guess what happened right after COVID? Well, there's nobody on the parking lot and grass start growing from the parking lot. But as an in-house team, we couldn't, if it's a third-party management, we couldn't even get people out there to clean up the property. So fortunately, we do have a strong in-house team, and we continue manage this property throughout COVID. So we actually made a decision saying, this COVID is not going to kill us, and people are going to eventually come out. So we decided to take advantage of that downtime and renovated the center. And guess what? Right after, and the leasing start going up. So we actually stayed ahead by making that decision to continue to add value to this property. For people who live in Atlanta, this is right in Johns Creek, across the street from St. Ives Country Club. There's multiple restaurants opening there, and we're just very happy to see the local business that chose us to make them the business base, and which is their second home. And I really see this, WePartner company and our tenants are actually partnership. The more we do for the property and the better their business perform, and the day is a win-win. So on the financial side, we actually increase the value, by at least the 15% since the COVID. So we're very proud of our team that be able to put in the amazing work to make this happen. Another, so this is a case study. This is what we call it flex. Flex means that you could use, means flexible. You could use the front part as office and use the back part as a light like produce center. Or for example, like furniture showcase, right? So you could use it as a front, use a showcase, and use the back to produce something. So very light industrial. And actually more and more business moving into those type of more and more retail liking business, like the dance school, right? They need a lot of space and they will love some visibility, and they can't afford a huge rent. And this is a kind of right between big industrial like a warehouse and retail. So this is very well received by small business. So we bought it, we acquired in actually 2021, kind of right sort of in the middle of COVID. It's through a private relationship. Another thing is to do commercial real estate, it's all relationship based. They brought us this deal. They believe we have ability to close. and they believe we have the ability to manage, and which is exactly what we did. So it's compared to retail, this product is actually really it's actually simple. So literally, you don't really have to make it Taj Mahal, you know, you can just clean up the parking lot and put in simple landscaping, you know, keep trash, you know, away from the property. And the people are okay because they're not expecting this is a full service Class A office. They just want to make sure this is safe and clean. And that's exactly what we did. So we literally increased the base rent by 23%. The reason we could do that is we're also value add company. So when we acquire property, we need to see, other than treat the tenants well, collecting rent, what else can we do? You know, can we renovate the property a little bit? Can we restructure the rent? Ideally, we want all our flex tenants to be triple net, because then the tenants taking more responsibility as far as consuming resources, you know, utilities, things like that. That would be ideal. So we restructured some of the rent and reduced our expenses, actually increased the NOI. NOI is a key word in real estate, by 6-8%. So this is a great case study that definitely taught us a lot. We don't buy a property and sit on it. We keep doing things to it until the tenants is happy, until all the tenants are happy, and bring the property to the market value. Here's another case study, is the retail. This retail center is in Roswell. So again, this another center that we made a bold decision to spend $250,000 to renovate this property in during COVID, because even my GC contractor said that was easy because there was no traffic. He was flying on 85 and just bring a few guys and continue to work until the center looked amazing. We even put a string lights in. So as soon as the people were allowed to come out, there was a gym in that. There is still a gym in that center. So people were so happy to see a freshly painted, renovated, beautiful string lights. So this was such a good feeling when the tenants sharing their feedback with us. So
Rose,
now
it's so
the
funny,
center.
that's my gym.
Is that your gym?
It is.
Oh wow! See, that's awesome. So that's how we see it. We're each of our property, we create a community, and people feel safe and happy, and look forward to go there. For the tenants, look forward to go to work there, and for their customers, they look forward to go shop there. So we increased our occupancy rate from 70% to 100%. Amazing job for our team. Oh, this is another case study, Calhoun, Georgia. We had this great agreement with our builder, which also we have a relationship with. Basically, the deals we do this is we receive our line of credit from our banking partner, and they allow us to close as the builder build. And the builder actually work with us as we leasing. We could slow down. If the leasing slow down, they can slow down the construction. I mean, in real estate, it's all about partnership. We have to build a supportive community, and so we can all work together and advance together. Oh, this is another wonderful case study I wanted to share. Where they closed this and sold it. Actually, we sold it in 2021. A lot of things going on, huh? In 2021, this definitely helped us to get through a very challenging time between 20 and 21, because this was purchased at the beginning for our company. Honestly, at that point, I didn't know this type of flex worth that much money later on. Well, that's why in real estate, you got to stay in, okay? Because it's going cycles for sure. When we bought this property, I didn't even, it doesn't look pretty. but it's not about all about looking pretty. So it doesn't look pretty, and it was so easy to manage at that time. So we successfully sold it 3 years later, and investor has realized a return for 28%. And the funny story is I actually went to a conference in California, and I ran into the buyer, and I said, the buyer, and they told me, well, that we bought a property from you guys, and so actually we love it, you know, thank you, and there's other deals we could work with. I was like, I hate you, because the property probably worth doubled. But Mark told me just to be happy with the 28%, okay? So anyway, it's just a funny story that I actually met the buyer of this property. And they're actually holding this property in their family office. What they told me, they're holding this forever. I mean, we're learning as we go, right? Because there's so many changes in real estate. What I realized, a lot of investors, especially family office, a little bigger than we are, they actually play this long-term. They're more long-term player. When they see good assets, they want it to buy and hold. So for us, because we're raising retail investor money, we normally commit it to an exit plan. 3 to 5 years, and maybe 7 years is kind of our max. But as I said, moving forward, we would love to develop a strategy or maybe a fund to buy quality assets and hold it for long term. Because when you buy and sell, when you flip, there's a lot of costs in between. You know, you pay, you pay legal, you pay broker. The next thing you know, you owe a lot of money to Uncle Sam. So we need to get those part figured out, right? Oh, Henry Home. We also closed this property. We bought 46 homes from a broken subdivision, and the developer went in, built a 46 home. We actually spent a year just to figure out the HOA. It was a mess. They formed the HOA 3 times. And then that get to the point that they couldn't close, but because the documents are just not clear. So our asset management team spent a year figure out the HOA, get a hold of everybody, go through a voting process eventually, and allowed us to own a portfolio, a rental portfolio. Then we turned it around a couple of years later, and we sold it and it made 18%. Which we were very happy at this point. And guess how much of those homes are worth now? So 3.5 years later, it's actually doubles value. We sold it at the 230,000 a door. Now it's like 35, something like that. So but I guess my point is, I'm very happy. I'm very thankful that we were able to work hard, and the hard work yielded good results. So our team, our investors are very happy. But my point is, there are assets should be held longer term. We need to give real estate time to grow, and we need to give our team time to grow. So the real estate has value. So just allow some time if you can afford it. For a company like us, we're still growing. That's why it's a constant struggle and debate for me is, are we making short-term decisions trying to continue to build our track record, or should we position ourselves for long-term wealth growth? The answer is we're doing both. That's why we're thankful that our short-term investor, long-term investor actually continue to believe in us and continue to support us and support our growth together. All right. Any questions so far about our case studies? I think I kind of run through 5 case studies across our asset class.
Let me just bear with me. Let me see if there's anything in the chat. You can go ahead to talk about the offerings that you typically give to your investors If you have questions, additional questions, feel free to put those in the question box.
Yeah, wonderful to share. Okay, so how do we so I'm trying to find a keyword to say that. Like, what do we do, right? And how do we became a private equity investing in commercial real estate, and how do we grow from there? What is the key component we must have to be in this business to be successful? And the key word is the capital, right? We have a team, we have a platform, we have 10 years in business, we have divide and conquer and accomplish a lot. For us to continue to grow, we must have a good capital to come in. And that's what real estate is all about, is to invest and grow. So the offerings that we are comfortable with and we have been doing is just imagine how do we invest? There are only a couple options on the market. You either put in your money in the equity market, or you put in life insurance, or you put in real estate. And what I tell my investor is just diversify, right? You should definitely consider some money to be in real estate. So for what we offer is equity investment. When we talk about equity, there is some risk to it. So we want to be very conservative, especially with our equity investors. And another one is debt investment. As you all know, on the capital stack, right? Who is the safest investor on that capital stack between the senior lender and the preferred equity and the common equity? We normally offer 3 levels. So the senior lender, when we do raise private money to replace bank now, because the bank is just too expensive. And I feel like I want to offer that opportunity to our conservative investors if they're okay with the 8 to 9 returns. Like, why not? Because the bank's position is the safest position with today's interest rate being so high. And we actually have very, very conservative investors are willing to accept the 8% return. And actually, that's an amazing spot to be. So that's why I tell our investors what we could do in a very conservative, uncomfortable fashion. I would say 8 to 12%, because equity could achieve around 12% and debt could be around 8%. And between there, we all should be able to make a living and make a good living. Because of who we are, we want to be flexible. Being flexible just to offer our investor different options between the debt and the equity, and between the short term and long term.
Okay.
I hope that covers the offer.
Yes, and I did have a couple questions that came in as well.
Okay.
It says, do you invest nationwide or just local to the Georgia area? Okay,
amazing question. So again, I am my background is accounting and finance. I'm actually still a CPA. So I am very, I need to be able to drive to my properties. And that's kind of the reason we have been staying in Atlanta. And are basing in Peachtree Corner. So my initial guidance within driving 2 hours distance. So now after 10 years, and we definitely want to expand to other states. But I'm still trying to limit it to driving distance. Like, we're trying to go to Tennessee, South Carolina, North Carolina, and Alabama. So with that being said, we're also open to other states if we have local partners. That's kind of our general guidance for next for our acquisition at the moment.
Okay, next question is, how frequently do you do distributions to your investors?
Love that question. If we do monthly, because I don't believe you should starve yourself to invest, by the way. So whenever we do monthly distribution, because I want the investor to get paid every month so they can go out for dinner, go on vacation, and just improve your life. So monthly, I want to get the money monthly. So, and monthly actually make it easier for our accounting. So they don't forget, always recur on the monthly basis. It's just less room for mistakes. So the answer is monthly, and I'm very proud we're able to execute that.
Thank you. One other question is, what type of insurance do you carry?
What kind of insurance? I'm happy to have our, direct operations who are in charge of our insurance. We carry all kind of insurance. Insurance is actually a big deal in real estate. You make sure you have your professional liability insurance, you have your umbrella insurance, you have your property insurance, you have your workers' comp insurance. Honestly, one day WePartner is gonna own the insurance company because they're making so much money from us. So the answer is we're carrying all the insurance we need to carry to protect our investors, our assets, and our staff.
Okay, great. One question that just popped in again. It says, what are your minimum investment amounts?
Our equity is $100,000. Our debt investment is 50, because the debt investment is easier documentation, and the equity is just a lot of more to be in compliance, a lot of more documentation, and it also is riskier than debt. And we want people to be able to be able to perform, and they should be in the position and to invest.
Thank you.
So 50, 100.
Okay. One question that says, what fees are there? You do have Advanta related fees to have an account with us. I can certainly, talk you through that. We work with WePartners and their clients, so we've had some customized pricing built in. But I can certainly help you if you're looking to get your self-directed account open. I don't know if you're specifically asking if there's service fees for WePartners if you invest with them. Rose, I don't know if that's applicable to you.
Well, thank you to you. Reneika really streamlined our onboarding process with our investors, and also have streamlined fees with us as well. That allows us to offer a good service.
But just to answer, maybe just to give clarity. So if you invest directly with WePartner through an equity investment or a debt investment, there are no additional fees charged for those investments. If you invest with WePartner through your self-directed IRA, then there are fees charged by Advanta for the asset. And Reneika, you've got all the clarity on that. There's a one-time expense that you charge, and then there may be an annual fee as well, but no charges by WePartner.
That's correct. Another question that just came in, just bear with me. It says, I'm currently planning to develop a 26-unit single-family community in upstate New York. What a partnership with your company look like, and what could you provide me? I would suggest that you reach out to them directly just to see if that's a conversation you can have offline, but they're asking, they're doing a project in New York.
Oh, wow. I actually just came back from New York 2 days ago. I love New York. I actually went to NYU for a year. But as far as the project concerned, that takes a sit-down meeting and a call. Development is complicated. Our company owns the land. We have made multiple attempts to develop. Eventually, we decided we're only going to do JV. We want to work very people who have experience in that space, and we just leverage each other. That's definitely a safer plan for me.
Thank you. Rose, you can go ahead. I see you have another slide up.
This is my last slide, and it's also my favorite slide. 5 years ago, I asked our branding consultant to create something for us, and it's right before COVID. So he actually came up my favorite mission, and so just think about it. Why we're working hard? Why are we getting up in the morning? Why are we doing real estate? End of the day, we want to be happy. We want our investor to be happy. We want our staff to be happy. We want to take care of our children. We want to take care of family. So that's what motivates me in the morning to get up, is to not to disappoint one and bring more happiness to people. That's why our entire company is to follow our mission. And this, especially in real estate, you actually is more impactful, because if we we take care of our property and the tenants are happier and their guests are happier. So I definitely can talk a lot about this, our mission for a long time, but I don't want to take too much time today. But anyway, so our goal is to really use the power for real estate to build the human connections and the happiness. So that's what I want for everyone today.
Thank you, Rose. Thank you, Mark.
And we'll wrap up. We've talked a lot today. We'd love to talk to you. If you have an interest in WePartner, be it through self-directed IRA, through Reneika, or otherwise, you can see there our contact information. Feel free to reach out to us either by email or through my direct line, and I'm happy to start the conversation. And we'll look forward to hearing from you when the opportunity presents itself.
Thank you so much, Mark. Thank you, Rose. Excellent presentation. Thank you, audience, for attending. Thank you for asking questions. This will be uploaded on our YouTube channel later today or early tomorrow. If you'd like a copy of the slides, feel free to reach out. You'll be able to get a copy. With that, I'll tell everyone, have a great rest of your day and happy investing.